Arbor Realty Trust, which is ticker symbol ABR. This is an in-depth video. In fact, it's probably one of the most in-depth videos we've ever done on a stock like this. Our members can request me to do a full back test, my opinion on a stock, comparing it to the S&P and like-minded stocks, but also with a full chart analysis from Sensei. We've never done it before in that way. So this is the first for this. In this video, you're gonna hear what I think about Arbor Realty Trust, what I think about these types of investments, how it compares to one of the most famous, of course, we'll come on to that, how it compares to the S&P. Is it a good investment long term? Excuse me, my price target, where I see it going, and also some chart analysis, some levels, some resistance, support, and so on, done by our chart expert analysis, Sensei Crypto, who now has his own show on Sunday. Click above my head. This Sunday is his world premiere. We're very excited. Live on my channel will be Sensei's own show. So we're looking forward to all of that. So let's get straight into it. So for those of you who don't know, what is Arbor Realty Trust? Should we be buying it? Should we not? What is it? Let's have a quick look. All right, let's zoom in just a bit more so you can see what we're looking at right now. And at the end of this, I've got a bit of a surprise as well. So stick around for that. Those that are watching me live, that is. This is made during a live video, so everything is real. Arbor Realty Trust operates as a real estate investment trust, which engages in the provision of loan origination and servicing for multifamily, senior housing, healthcare, and diverse commercial real estate assets. It operates through the structured business and agency business segments. The structured business segment offers structured loan, origination, and investment services. The agency business segment is involved in agency loan, origination, and servicing. The company was founded by Ivan Kaufman in June 2003, so it doesn't have a great deal of history yet, so the back test isn't as effective as it might be. However, we're going to do it. And is headquartered in New York. The listed name is ABR. Okay, it's got 630 employees, around since 2003, a market cap of 2.85. So we're not a penny stock. Price earnings ratio is 9. 9 is the price earnings ratio. That tells us how expensive it is, the price to the earnings ratio, what you're going to earn in ratio to the price you're paying for the stock. So when you look at the price earnings ratio, you have to compare that to others in the same sector. There's no point comparing it to Tesla or Google or something. You have to compare it to similar stocks in a similar field. So looking at realty income, for example, price earnings ratio is 40. Not exactly the same, but a similar structure. Anyway, so the price earnings ratio is fair. It pays a very good dividend. Now, we've been asked to do a full video on dividends, and we will do that. Look in the series and you'll see videos about dividends. If you have a high-paying dividend stock, the chances are you're not going to get much growth, because they pay in dividends. Very often, this kind of investment is designed for people that are not looking for growth. They've made money. They're wealthy senior people who just want a passive income, a dividend stock they can live on and have that coming regularly, and so on and so forth. Tends to be the older generation will buy that. They've made their money in growth stocks. They're now in dividend stocks, which don't grow very much, but give them a dividend. However, if you buy a stock that pays you a good dividend, it probably doesn't have much growth or maybe negative growth. So you need to compare that. If you look at it and go, well, I'm making great dividends, but your assets are going down in value overall, is it a good investment, and are you making money compared to somewhere else? So it's always worth noting that. But anyway, it looks on the face a good dividend. And also, how often does it pay it out? No point promising a high dividend if you've only paid it out once. Coca-Cola, J&J, they are dividend kings, because not only do they always pay out, they increase what they pay out. I think Coca-Cola over 68 years, don't quote me on that, somewhere like that, in the 60s anyway, continually pays out, continually increases what it pays out, and it has a growth. You can't expect as much like Tesla as a growth if you're a dividend stock. It's structured differently. It's structured for a different type of investor. So you decide where you are. Have you got to build a dividend, a portfolio, then earn dividends, or are you just living on dividends? You got to decide. Anyway, it's a 52-week low was $10.10, and its low today is $15.12. Okay, that's the initial look. Let's scroll down here. Now, our analysts give it a 50% buy. Now, don't always take these analyst reports as gospel because they are very often out of date. These can be up to a month sometimes out of date. So this might be a month ago it was a buy, today it's not. Also, analysts can be biased. They can be swayed in one way or another. Don't take it. Analysts say it's great, so I'm buying it. They can be swayed, and there can be a bias there. So just bear that in mind. However, if you see consistently a 90% buy by a good number of analysts on a stock, it probably is generally considered to be good. Just don't take it as, well, I'm buying it because the analysts say I should. Okay. So as you can see, 33% saying sell. So it's got a mixed bag. Now, as we can see here, not a surprise, as I predicted, and this is the first time I've looked at this stock. So I'm looking at it for the first time. So when I say things and I scroll down and I get it right, that's just, I got it right. I'm not pre-planning this video. I'm doing it in a live video. Now, I said it's got a good dividend. It probably doesn't grow very much. As you can see, the earnings, it hasn't grown very much. No surprise, because it's paying out its profits to its shareholders. So it can't, can it? So it's a profitable company. And right now we want profitable companies because the markets with the rates where they are, and we're going to go sideways for a while. We need companies that aren't in debt right now. Now, I'm not looking at the financials. Maybe Sensei will do that in a few moments. But I'm not looking at the financials today. I'm just looking at the basic principle of this stock, comparing it to a back test of the S&P and Realty. We'll do that in a second. But you can see here, it's beaten expectations. Now, that's good. And the reason why it's beaten expectations, and from my understanding of the general markets, not this actual stock, because it's the first time I've looked at it ever, is that commercial real estate has been losing money. We all know the famous story with Elon Musk getting the Twitter offices cheap and so on and so forth. A lot of commercial buildings, because of the state of the economy, have been losing money and unoccupied, and industries investing in commercial real estate have been losing money. So the expectations were low, but nevertheless, this company has managed to make a profit and beat expectations consistently. However, what's interesting is the Wall Street, and they're the ones who set the analysts, they're the ones who set the expectations, not the company itself, remember. They haven't really revised it upwards. They've continually said, no, it's not going to do that well, and ABR beats it again. However, they haven't continued to raise their expectations. The street sometimes can't. We know that the street doesn't know how to value Tesla because the robo-taxis, the Cybertruck, the licensing, all these things haven't happened yet, and the street don't like uncertainty, and they don't like things they can't price in. So very often, a company can be underrated, undervalued, and overperform, and the street doesn't catch up with it. It just leaves it alone. It doesn't know what to do with it. So this is good, and they've beaten expectations consistently. I now like to look down here. This is very important. This is often overlooked when I ask people. People don't even scroll this far down. For me, this is the most important part. This tells me who buys this. And I love when this happens. Because I'm looking at it for the first time and I'm kind of backing up what I said before I knew it, right? Realty income, number one. I used realty income as a comparison when I was setting up this video without looking, and I was right. It's the same sort of people. Elderly investors with money. And that's good. That's good. It means the stock is less volatile. If we look below here and we see Mullen and we see things like AMC and we see Bed Bath and Beyond, we see rubbish companies that are all over Reddit. We know the stock is going to have volatility. We know it's going to get shorted. No one's going to short this stock. No one shorts realty income. No one shorts things like that because these are consistently making money. You don't short Coca-Cola. You don't short J&J. I mean, some people do, of course, but very, very low. So this shows us the people that buy this are sensible people. That sounds a bit crazy, but it's important because we don't want to see a bunch of junk stocks all littered down here. So scroll to the bottom, find out who's buying the stock. That's very important. Very often overlooked when I ask people on Robinhood how many people look at this, and they tell me very few people use this service, and it's actually quite important, if not one of the most important things. I use it all the time. Anyway, so that's good, right? Arbor. So far, looking pretty good. Let's go over its history. Now, unfortunately, this is a bit distorted because it's only been around since 2003, IPO'd here, popped up, and of course, now we have this crash here in 2008. I beg your pardon. 2004, 2008. Of course, we had the crash. Very familiar with that. It's not been around that long, so it's up. If it started here, its growth would be a lot less, right? But anyway, beside the point, we can't compare it going back like or the S&P. It's got a very limited period of time. But in 2008. We can see this was the crash that we experienced in this sector, and then it gave people the opportunity. You remember Michael Burry shorted the market. We had a huge crash across the United States and around the world, for that matter. So we can see that here, and since then we've had growth. We had March 2020 dropped off. Pretty much every company had that issue, other than, of course, Zoom and those that took advantage, Moderna, COVID vaccines. Others took advantage of this, but most companies lost out when this happened. Not all, but most. Anyway, so we get an idea of where we're going. We look at it over the year to date. Most companies are up by this amount. This is nothing amazing. The S&P is up. I'm up more than this. I was at 25% year to date. I'm back down now, but this is quite good considering we've got a dividend stock that pays 10%. However, we need to know. I haven't got time on this video to look at my dividend payout history, but you'd have to see how often it paid that out. Because if it's had that sort of growth over the year, year to date is 14%, and it's paid a 10% dividend, then it's done very, very nicely. Thank you very much. However, has it paid out every occasion? I don't know. On this video, we're not going to look at that. Right, let's go into my back test, and then we're going to go to Sensei from a chart perspective. If we compare it. Now, what I've done here, to so you know, I've gone from 2005, because 2004 IPO'd. I'm not interested in the first year when everyone buys it and drops it. Not interested in that. But what I am interested in is from 2005. I put in $10,000. So you can see here, I put in $10,000 hypothetically, ABR, VU, and O. 100% of ABR, 100% of VU, 100% on O, and then we get a comparison, and then we can compare. So when you're investing in something, the first thing you want to do is do what I've just done, look at the basics, then look at the financials, and we're going to touch on that with Sensei in a moment, but compare it now to something else. Before we get carried away and think, hey, great, I'm going to buy this, it's brilliant. Well, hang on a minute. Where is my money best suited? Where's it going to work the best? Maybe I can get more if I buy something else. So before you jump on in, compare it to something else. So if we compare Arbor. Arbor's in blue, and you can see how Arbor's performed very, very well. You can see it reacted massively in March 2020. We can see it really did get affected more by macro conditions. Now that's important because we have, and let me just say, we have the S&P in red, we have Realty Income in yellow. So you can see that Arbor since 2005 has outperformed and outperformed the S&P. Looks pretty good. Full disclosure, I've set this up to reinvest those dividends. This is set up to reinvest all the dividends. So with ABR paying high dividends, they've been reinvested automatically on the dividend day, not randomly or manually. They've been done on the dividend payout dates. Okay, so overall, you've had this a good return. However, what I don't like to see is if I'm buying a dividend stock, if I'm buying a stable company like this, I want stability. What we've got here is a dramatic downturn, but then we had a dramatic upswing. So that is a concern because that would indicate, have they paid out all of the dividends? I'm just reading in the chat from Seth. Let's have a look. Did he write that down? Every 3 months it pays out. They have increased the dividend every year over year recently, and it's every 3 months for those in the chat wanting to know. So Seth has done that research. I haven't got time to do it right now, but he said they've paid every 3 months, which is a standard, and they've paid they increased year over year. But how often have they increased? I don't know. This video isn't going to answer that question. You can do your research on the dividend payouts and the history, and you can look back. But for a dividend stock that provides stability, I don't like this, but then you get the swing. So it does look good. Is it a buy right now? I'm not in this. I won't be in this stock because I am not at the stage where I just want to hold and receive dividends. However, this has had growth as well as dividends, so it does look interesting. But for me, I'm looking for growth stocks, space, AI, EVs, Tesla, to make my $200,000 hopefully by the end of next year. And then I can move into more of these, and then I'll be reassessing which ones I want to buy. Right now, I'm 54 years of age. I'm not planning on retiring anytime soon. I've got chance to make growth stocks and then buy this. So that's my take on it. It does look pretty good. Is it a time to buy it right now? Not for me, because I'm not buying this type of stock right now. But as you can see, it's outperformed the S&P, outperformed the most famous of all realty stocks, which of course is Realty Income O. It's a favorite amongst rich, wealthy, retired people. But this is interesting stock, no doubt. Let's go and get a perspective now from Sensei, who I've held on the phone far too long, but he is here with us now, and he's going to give me some information on their financial position, also a chart position. I've just done the basic principles of it. Now we're going to hear from Sensei from a chart perspective and more financials. Okay, let's go over to Sensei now. Sensei, thank you for being so patient and staying on the line for me. What do you have for me?
No problem. Yeah, this looks like an interesting company for the people that like to invest in the realty side of things. I mean, personally, I think when it comes to real estate, it's better to try and get involved yourself in a way that you actually own these properties, whatever way that could be. I don't really like any stocks that do it for you, because there's so many middlemen, you lose a lot of value. But looking at this stock itself, for the dividend side of things, I've just pulled up the dividend yield. It seems to be increasing. They seem to have been paid out since 2016. It's getting more reliable. The payout ratio is now around 93%. We can see they've been increasing it over here. They have missed a couple, I believe, otherwise that percentage wouldn't be It would be 100%, I think. But yeah, it looks like they're paying it out. It looks like they're increasing it, which is good. Like nice higher dividend, and he said the income, their revenue seems to be increasing. I just had a quick look at the quarterly. That seems to be another. As you can see, it's really the dark blue line there. You can see it's increasing, and it looks like 2023 is going to be another record. So that's good. But now, what I like to do, for me, it's all about the chart. And looking at the chart, it looks good. I mean, what we want to see with, I mean, obviously this area here in 2008, I think that's to be expected. I mean, at the end of the day, it was a real estate crash that led the market crash, so no surprises there. But if we sort of ignore that and start looking forward, all I see in the chart is a low, a higher low, higher high, higher low, higher high, a sideways action, lower, higher low, higher high, higher low, and then we got the COVID crash. And as you said, that did happen to basically all stocks on the market, not all, but most. 95%, I guess, and then we got that crash. But once again, we have taken out that high from the pre-COVID, which is good to see, and now we've put in a higher low. So the market structure seems to be upwards. It's slow in my opinion, compared to some of the more growth stocks out there. Level wise, I think it could come back to $13.50, and if we do see a market crash, I think $8 is the level. But for me, I don't like investing in real estate companies on the stock market. I'd rather get involved myself somehow, and actually own a chunk of them. Other ways. But yeah, that's my thoughts on the chart. And it's also not in a sort of an oversold territory, so there's not really too much there's not a buy, there's not a sell at this current moment.
Thank you very much, Sensei, for your thoughts. I appreciate that. Hope you enjoyed that from Sensei. I agree with Sensei. If I was into realty, I'm just not interested in it. It's not something that floats my boat. However, if there's no question about it at all from most investors, you can make more money owning real estate than the stock market. If you buy the right property and do it up and flip it and so on, or rent it out, there's no doubt about it. You can make more money by buying property and holding it and renting it or flipping it than you can on the stock market. And if you are interested in realty, land and property and stuff like that, then buy some property and start flipping it and start being an investor that way. However, you might not want to do all of that, and I can't be bothered. I have a property which I just keep. I don't rent it or anything. It's just my home in England and my home here in the US. I'm not interested in it. However, it does look pretty good. I hope that was of use. I'm going to wrap up this video now. So if you click above my head, that will take you to my X account, my socials, and you can see more information of when I buy, when I sell, my trades, and get more information. You can also direct message me as well through my X and my Instagram and all those different links. Over here, you'll see our Friday night music night. We're going to do a concert tomorrow night. We're looking forward to that. Down here, more in this series. If you want to go and check out the videos, I think you might find useful. But if you want more information from Sensei, his services, he does run our crypto challenge and has his own show this Sunday coming up as well on my channel. Tune in for that. Links are below and above my head and all that stuff. And I hope that was of use. Arbor Realty Trust. For me, it's not one that I'm looking to buy. I'm looking for more growth stocks right now. I'm not really a fan of this kind of stock. However, it does look pretty good. Until next time, as always, take care of yourselves and each other.